Hello friends, welcome to my channel IFRS-world. I am Chandni Gupta and I help you understand IFRS with the help of my doodly videos and simplified notes. We have been learning IFRS 16, that is on leases. In my previous videos, we have learned how to identify a lease in a contract. Then we understood the meaning of certain terms used in the standard. Then we learned accounting treatment in the books of lessee and in the books of lessor. Now in this video, we will learn certain miscellaneous topics that are really important to understand. Our first topic is sale and leaseback transactions. Sale and leaseback transaction is an arrangement where a party sells an asset to another party and takes the same asset back on lease. Now suppose A has a building which she uses it for her official purposes, but because she is in need for some cash, she sells that asset to her friend B. However, because she wants to keep using that building, she takes the same building from B on lease and retains every right to use the said building. Why would any company do something like this? There could be multiple reasons, out of which some are in order to influx some cash in business by selling the asset and also by retaining the right to use that particular asset. Or when the company wants to save some taxes. So if you're a lessee, you get depreciation on the ROU asset, which is the right of use asset, and also the interest charge on the lease liability that you charge in your P&L. The depreciation and the interest charge both are tax saving items. So when the company influxes cash by selling the asset but also leasing it back, do we book it as a sale and show it in our P&L with some gain or loss on the sale transaction? Well, partially yes. Now suppose A has that building in her balance sheet at a value of 55 lakhs and she sells the same asset to B at 80 lakh rupees, which is also its fair value. So in this case, A has made a gain of 25 lakh rupees on sale transaction. But does this really a realized profit on the sale? Are we not going to look at the liability that has been incurred by A due to this? And moreover, is the sale actually for the entire asset? Because naturally she has retained certain rights to use that asset for a particular period of time. Therefore, we are going to consider all of these. We are going to recognize profit proportionate to the rights that are actually transferred. And we are going to recognize the liability as usual of the present value of lease payments and we will also recognize the right of use asset representing the A's rights to use the asset for a particular period of time, which is called as the lease term. So if you see in this case, the normal profit on day 0 at the time of sale transfer is 25 lakh rupees, which is the difference between the carrying amount and the sale value. However, since the lease arrangement has been agreed for lease payments of 5 lakh rupees for 15 years with an interest rate implicit in lease at 5.5%. Now when we discount 5 lakh rupees for 15 years at 5.5%, we get a present value of 50 lakh rupees, which represent the fair value of the lease liability on day 0, that is on the date of transfer. Now using these values, we are going to calculate the carrying amount of the right of use asset. Right of use asset will not be recorded at an amount equal to the present value of lease payments, but it will be at a proportionate amount of the carrying amount of asset in the books of A. Therefore, we calculate the proportionate amount using the present value of lease payments upon fair value to carrying amount. we arrive at 34.4 lakh rupees, which represent the part of carrying amount that has been retained by A. The difference between the actual carrying value of 55 lakh rupees minus 34.4 lakh rupees represent the rights that have actually been transferred. Therefore, 20.6 lakh rupees is the carrying amount of the rights that have actually been transferred. Now, since we have got the carrying amount of the rights transferred and we know the overall profits, we can also calculate the profits pertaining to the rights transferred, because ultimately we are just going to recognize the profits that pertains to the rights that have been transferred. Therefore, to calculate the profits pertaining to the rights transferred, we first calculate the profits that pertain to the rights retained. Using the same formula as the right of use asset, we calculate normal profit to present value of the lease payments, which represents the fair value of the lease transaction, divided by the fair value, and we arrive at 15.6 lakh rupees. That represent the part of normal profit, the part of 25 lakh rupees of profit which pertains to the rights that have been retained, which we are not going to recognize upfront in P&L. Now, we calculate the profits on rights transferred by subtracting the profits on right of use retained from the normal profit, which is 25 lakh rupees minus 15.6 lakh rupees, and we arrive at 9.4 lakh rupees. Now, this is the amount that we are actually going to recognize in profit and loss account on day 0, that is the date of transfer. Now, if you see, here is the entry that lessee or the actual seller is going to record, which is the buyer account, which is actually the lessor now, at the sale value of 80 lakh rupees. Right of use asset will be recognized at the portion of carrying amount that pertains to the rights retained, which was 34.4 lakh rupees. The asset account will be de-recognized, will be credited using its total carrying value, which we have done here is building account credit by 55 lakh rupees. Lease liability will be recognized at the present value of future lease payments, which is 50 lakh rupees, and the profit and loss account, which is basically the profit or loss. In our case, it's the profit that pertains to the rights that have actually been transferred. So what is the meaning of this entry? The meaning of this entry is that when we sell, but when we lease back the same asset, we recognize the profit that pertains to the rights that have actually been transferred in this arrangement. We de-recognize the complete asset. We recognize a right of use asset for the rights that have been retained as a part of portion of the carrying amount. We recognize a lease liability for the present value of future lease payments. And subsequently, interest will be charged on the balance of lease liability using the same interest rate that we use to discount the future lease payments. Actual lease payments will be adjusted in the balance of lease liability, and the right of use asset will be depreciated over the period of lease. This was the treatment in the books of original seller, which becomes the lessee after all. Now let's understand the treatment in the books of buyer, or we can say the lessor. So the lessor will initially recognize the asset at the fair value, which in this entry we have done building account debit to 80 lakh rupees. However, since the lease transaction has been done, he will further de-recognize the asset, will recognize a finance lease receivable at the present value of future lease payments, and the difference will be recorded in P&L as gain or loss on the lease transaction. This is the usual treatment that we do in the books of lessor. Now, there can be cases where the sale or the lease is not at the market terms. Well, when the lease or sale is off the market terms, we make certain adjustments. Now, suppose in our previous example where the sale price was equal to its fair value, is actually the sale price is 90 lakh rupees instead of 80 lakh rupees, which is the fair value. Now, in this case, the excess of rupees 10 over the fair value would have been an additional financing arrangement, and lease payments would be a portion between the lease part and the additional financing part. That means out of the present value of lease payments of 50 lakh rupees that we had just calculated, 10 lakh rupees would have been the additional financing part, and the annual lease payments of 5 lakh rupees would have been divided in the ratio of 1:4. Because out of 50 lakh rupees of present value, 10 lakh pertains to additional financing and remaining 40 lakh represents the actual lease part. And in the same manner, the annual lease payments would also be divided in the ratio of 1:4. And in case there's a situation where the selling price is less than the fair value. Now suppose if the selling price was 75 lakh rupees instead of 80 lakh rupees, then the difference of 5 lakh rupees would have been recorded as a prepayment of lease. Now this was the treatment when the transfer of asset on day 0 actually amounted for as a sale as per IFRS 15. Now what happens if the transfer is not a sale at first place? Then the asset is not de-recognized from the books of seller, and the amount that has been transferred on day 0 will be recognized as a financial liability by the seller and financial asset by the buyer. And the financial asset and financial liability so recognized will be accounted for using the guidance of IFRS 9. Our second topic is subleasing. Now suppose A leased an asset to B. B leased the same asset to C. Well, as per this new IFRS, for a lessee, there is no such concept of classifying the lease into a finance lease or an operating lease. Therefore, subleasing can be done in any case. Now, IFRS 16 gives an exemption to the lessee to choose a simpler path of accounting as an operating lease when it's a low value lease or when it's a short-term lease. However, when the lessee intends to sublease the asset, the exemption of low value lease cannot be opted for. Moving on, the original lease will result into an ROU asset in the balance sheet of lessee. But now when the lessee subleases it, which means he is a lessor and needs to classify the lease into a finance lease or an operating lease. So here, A was the head lessor, B was the lessee of the head lease or the main lease. Now when B subleases the same asset to C, B becomes an intermediate lessor and C becomes the sublessee or the ultimate lessee. So now we will talk about the accounting treatment in the books of intermediate lessor or B. So now since he is a lessor and he needs to classify the sublease into a finance lease or an operating lease, he will consider the provisions of the original lease and the life of ROU asset of the original lease will be used to classify the sublease into finance or an operating lease. So basically, to evaluate whether a lease is a finance lease using the useful life criteria, B will consider the life of ROU asset, which is basically the lease term of the original lease or the head lease. Now suppose as a part of main lease, A leased an asset to B having useful life of 10 years. But the lease term was only 8 years. And B subleased the same asset to C for a lease term of 6 years. Now here, to evaluate if the sublease is a finance lease or not, he will compare 6 years of sublease term with 8 years of the main lease term. And in case the sublease is a short-term lease, that is, it is for 12 months or less, then he will classify the lease as an operating lease only. Now let's understand the treatment in the books of intermediate lessor, because the accounting treatment in the books of the head lessor or the lessor of the main lease and in the books of sublessee or the ultimate lessee will be as usual. But in case of the intermediate lessor, the accounting treatment is a little bit different. So when the sublease has been classified as a finance lease, the intermediate lessor will recognize a sublease receivable at the net investment in sublease using the interest rate implicit in sublease, or he can use the discount rate of the head lease adjusted with the initial direct cost. And correspondingly, he will de-recognize the ROU asset at its carrying amount. Any difference between these two goes to P&L. And subsequently, he recognizes both the finance income of the sublease and the interest expense on the head lease. Now, in case the sublease has been classified as an operating lease, he will continue to account for lease liability and ROU asset on the head lease, and he will book the income for lease payments received in the sublease. Our third topic is separating the components of a contract. As per IFRS 16, entities are required to account for lease components separately. A separate lease component in a contract exists if both the following conditions are present. Number one is the lessee can benefit from the underlying asset on its own or together with other resources that are readily available to the lessee. And number two is the underlying asset is neither highly dependent nor interrelated with the other underlying assets in the contract. In short, it does not affect the right to use other assets. The guidance of IFRS 16 also provides to separate the non-lease component from the lease component. An entity shall account for each lease components of a contract as a lease separately from non-lease components of the contract. Unless, so here's an exception, unless the lessee may elect not to separate them and account for each component as a single lease component. So basically, the standard is saying that all the lease components will be accounted for as a separate lease, as an individual lease, and the non-lease components will be accounted for separately. But the lessee has an option not to separate the lease components from the non-lease components, and he can account for both as a single lease component. When he chooses to separate the lease components from the non-lease components, he shall allocate the consideration. In case of a lessee, he shall allocate the consideration to each lease component on the basis of relative standalone price of the lease components and aggregate of all non-lease components. And the non-lease components will be accounted for as per the other applicable standards. The standalone price shall be determined based on price the lessor or the similar supplier would charge for the component separately or similar component. If the observable price is not readily available, the lessee shall estimate the price, maximizing the use of observable information. And for lessor, he shall allocate the consideration in the contract by applying IFRS 15. So guys, I hope this video has helped you understand these topics better. And if you have any query, any doubt, please write to me at Chandni@IFRS-world.in. For the summary notes related to these topics will be posted on my blog, and the link has been given in the description below. For upcoming videos, please stay tuned and please like, share and subscribe to my channel. Thanks a lot for watching. Bye.